Well, U.S. Treasury Secretary Timothy Geithner will also reassure Chinese officials about the rash of U.S. government debt issuances when he meets them next week. Geithner heads for Beijing this weekend for two-day talks with the Chinese government on June 1st and the 2nd. Well, the trip is his first since taking the job. And it also comes amid signs that the world's third largest economy is uneasy about the prospect of rising U.S. debt. The U.S. Treasury needs to borrow a record $2 trillion in 2009 to help fund a $1.8 trillion fiscal deficit. And China is the biggest holder of U.S. debt, and its huge dollar-denominated assets could be at risk if the dollar's value drops. Geithner is also likely to make use of the trip to convince Chinese officials about the importance of flexible exchange rates and smoothing trade imbalances. Well, let's try to make light of where the situation stands and try to find out where some opportunities are with Martin Hennecke, Associate Director at Tyche, and joining us as usual from Hong Kong. Well, great to see you again. You know, yesterday we saw that yield curve between the 2-year and 10-year notes hitting a record 2.75 percentage points. Do you think this could be a sign that the much worried about sovereign bond bubble may be bursting, and that may have already started?
Yeah, definitely. You know, we have been seeing, especially since the beginning of the year, so much pressure on the government bond auctions because, you know, what investors really do need to understand, the banking crisis, the subprime crisis hasn't been fixed at all. It's just simply transferred the problems from the banks to the books of the governments, especially in the Western countries. And now this is why, you know, the Federal Reserve has to raise and the U.S. government has to raise such, insane amounts of money. 1.8 trillion now is likely the deficit for this year. That's just a lower estimate. I mean, even Obama, as government came out saying they likely have to revise this because of the unemployment figures. We have now a 17th straight record of unemployment claims, and just the numbers across the board don't look particularly attractive. Obviously, we had David Walker, the comptroller of the United States, for 10 years, warning, you know, that these figures of the United States government don't really justify AAA rating anymore. And as we have just seen, PIMCO has also been warning Bill Gross that we might see the loss of the AAA rating status. So we think government bonds still are one of the greatest bubbles around. Precious metals are likely to benefit as investors who have been seeking absolute safety in those will shift some of their assets back into commodities, precious metals. And we also think the shift from the Western countries to Eastern markets is going to accelerate as well.
So ultimately, especially with the unemployment situation looking pretty bad, and obviously with the bond bubble that we're talking about, you're thinking it is a great hedge to protect one's wealth by maybe going into gold. I mean, gold already at 960. You're talking about commodities. They're picking up. Oil, we're seeing at 6-month high of 65. So tell us more about your strategy on which asset classes investors should be moving into at this point of time.
Well, our first recommendation would be actually to stay clear of any form of debt or leverage because for once the crisis isn't over, and in the short term it's very tough to see where exactly it's going to be moving to. There's still a lot of debt that has to readjust, still a lot of adjustable rate mortgages that will come up in the coming years. We have even seen just now a record delay rate of the mortgage payments of 12% now. That's an absolute high in the first quarter in the U.S., and even the prime mortgages now are coming under a lot of pressure. So still a lot of debt liquidation that has to happen. So there could be short-term some deflationary crisis that we see again. So one should stay clear of debt. But on the other hand, of course, inflation is going to increase very substantially as a result of all this money printing, as they can't really raise all these funds that they need to raise for the bailouts, and they will have to print substantial amounts of that. Quantitative easing will get worse. As you have said, you know, the Chinese are getting extremely nervous of this. We just had a projection from a Dallas Federal Reserve president saying that the unfunded liabilities of the pension and healthcare in the U.S. is 99 trillion. So inflation is going to be a major issue going forward. So even for cautious investors, they need to invest just to protect their wealth. Gold definitely is one of the asset classes we like. Of course, it's relatively high as it hasn't dropped last year. But if you compare to any historic numbers, we are still very, very low. If you compare to the 1980s high, for inflation-adjusted terms, that high would be something around 2,500. And for silver, inflation-adjusted, the high that we saw back then would be about $150. Now we are at $15 in silver. So absolutely absolutely, tremendous potential that you still see there. And again, China, we think, is comparatively much healthier than the West. The stimulus money really goes to the economy, not to the black holes of the banking industry like in the West. The renminbi is very undervalued, and we see good value in local, domestic-oriented Asian income stocks, again, especially China, but also some other countries within Asia.
So very quickly, before I let you go, do you think that we've kind of turned into a new chapter in that bond rates are actually going to dictate how the equity markets perform as we look forward to what's going to happen next week?
It's very interesting. You saw this week on a day actually when the equity markets when the connection between the equity market and bond market isn't there anymore. Even when people are scared the equity market has been dropping, people are not going to go for bonds anymore. The bond market has been dropping on the same day. So again, we think the bond market's dropping is not a sign of the confidence coming back. It's a sign that the confidence is decreasing of the bond market itself. We still think the bond market is one of the major bubbles right now. We would advise investors to stay well clear of Western sovereign bonds, especially the long-term ones, could be the worst asset class that we see over the coming years still.
Okay, we'll have to leave it there. Thank you so much for your thoughts there. Have a great weekend. Martin Hennecke from Tyche there in Hong Kong.